Margin of Safety by Seth Klarman is one of the most respected books in the world of value investing. It teaches a single powerful idea. The best investors focus on protecting their money before trying to grow it. In a market filled with noise, speculation, and emotional decisions, Klarman brings a clear message. Invest only when the price is far below the real value, so even if the future surprises you, your downside stays limited. This simple principle, called the margin of safety, becomes a shield against uncertainty. The book explains why most investors lose money, how crowd behavior creates opportunities, how to judge the real value of a business, why patience is more valuable than prediction, how disciplined thinking leads to long-term success. Klarman's writing is direct, practical, and deeply grounded in real-world experience. That is why the book is rare, highly sought after, and treated almost like a secret manual for serious investors. Whether you are new to investing or already experienced, Margin of Safety helps you think more clearly, avoid costly mistakes, and build decisions on logic instead of emotion. It is not about quick profits. It is about smart, safe, and thoughtful investing that stands the test of time. So let us step into the first chapter, where most investors stumble. Chapter 1. Where most investors stumble. Every journey begins with the first step, but in investing, that first step is often taken in the wrong direction. Most investors stumble not because they lack intelligence, but because they underestimate the complexity of the market and overestimate their own skills. They come with dreams of quick wealth, armed with half-baked knowledge and overflowing confidence. And in this rush, they walk straight into traps that have swallowed millions before them. The first big mistake is following the crowd. When the market rises, excitement spreads like wildfire. Friends boast of overnight profits, news channels scream about booming stocks, and social media buzzes with success stories. This creates a powerful pressure. No one wants to be left out. So investors buy at the peak, thinking the rise will never end. But when the market turns, panic sets in, and they sell at the worst possible moment. Buy high, sell low. A simple cycle, yet the most common way investors destroy wealth. The second mistake is confusing luck with skill. Suppose someone buys a random stock and it doubles in a few weeks. Suddenly, they believe they are a genius. They feel they have cracked the code. This false confidence pushes them to take bigger risks without understanding the dangers beneath the surface. The market rewards them once, but punishes them later. Sadly, most only remember the thrill of winning and forget the lessons of losing. The third mistake is ignoring risk. Many investors think only about return. They imagine the profits, but forget the possibility of loss. They do not ask, "What if I am wrong?" They do not build a cushion for error. Without this margin of safety, every bad decision becomes a disaster. Klarman stresses that the secret is not in chasing maximum gain, but in minimizing the chance of permanent loss. Another common stumble is impatience. Investing is a long game, but most people want instant results. If a stock does not rise in a few weeks, they dump it. If the market falls for a few months, they panic. True value takes time to show itself, but impatience blinds investors to the rewards of discipline. Finally, most investors underestimate human emotion. Fear and greed are stronger than spreadsheets and logic. Charts and analysis may guide decisions, but when the heart races, the brain often shuts down. People cling to losing investments because they hope to recover. They chase rising stocks because they fear missing out. These emotional traps, powered by the dopamine gap, are where most investors stumble again and again. The lesson is clear. To succeed, one must recognize these traps and build defenses against them. Investing is not about predicting the future with perfect accuracy. It is about avoiding the common mistakes that lead to ruin. It is about patience, discipline, and humility. But here comes a deeper question. Why do so many investors continue to stumble even when these mistakes are well known? Why do they gamble with their hard-earned savings, repeating errors of history? The answer lies in the mindset of speculation. In the next chapter, we will see how speculators and unsuccessful investors confuse gambling with investing, and why this confusion remains the biggest threat to financial survival. Chapter 2. Speculators and unsuccessful investors. Imagine two people standing at the edge of the stock market. One looks at numbers, studies businesses, and waits patiently. The other closes his eyes, throws a dart, and hopes luck will make him rich. The first is an investor. The second is a speculator. Most people, sadly, act like the second. Speculators buy not because they know what something is worth, but because they believe someone else will pay more for it later. Their question is not, what is the true value of this company? Instead, it is, how high will others push this price? This is a dangerous game because it depends on predicting the unpredictable. Human emotion, market mood, and mass psychology. Unsuccessful investors often look like speculators without even realizing it. They convince themselves that they are investing, when in fact they are only gambling. They may use fancy words, technical charts, or borrowed tips, but the core of their action is the same, hoping for quick gains without a clear understanding of value. Seth Klarman explains that speculation feeds on two emotions. The first is greed. The dream of doubling money overnight makes people blind to risk. They chase hot stocks, new technologies, or miracle companies that promise the sky. They forget that most of these promises never come true. The second is fear. Once losses begin, fear pushes them to sell at the worst moment, locking in disaster. Greed pulls them in. Fear throws them out. The cycle repeats endlessly. Speculators also fall into the trap of the greater fool theory. They believe they can buy something overpriced because a greater fool will appear to buy it from them at an even higher price. But what happens when no greater fool arrives? The bubble bursts, and the speculator is left holding a worthless asset. History is full of such examples, from the tulip mania in the 17th century to junk bonds and tech bubbles in modern times. Unsuccessful investors also suffer from lack of discipline. They do not define their goals, nor do they set rules. They buy on impulse, often guided by news headlines, rumors, or the loud voices of so-called experts. They rarely ask, what is my margin of safety? Without this cushion, every error becomes fatal. Another reason for their failure is overconfidence. After a lucky win, they believe they have a golden touch. They start ignoring research, dismissing warnings, and taking bigger risks. The market sometimes rewards them briefly, which feeds the illusion. But eventually, reality arrives with a heavy price. Klarman makes a sharp distinction here. Investing is about analyzing value, buying at a discount, and waiting with patience. Speculating is about betting on short-term price movements, often with no regard to value. One builds wealth slowly but steadily. The other destroys wealth quickly but painfully. Yet, the question remains. Why do so many people fall into speculation despite knowing its dangers? The answer is unsettling. The entire financial system, Wall Street, brokers, fund managers, and media, thrives on speculation. It feeds the dopamine rush of constant trading. It encourages activity over patience, noise over silence, movement over stillness. And that is the story of our next chapter. To truly understand why investors fail, we must look at how the very nature of Wall Street works against them. Chapter 3. The nature of Wall Street works against investors. If the stock market is a game, then Wall Street is the casino owner. The house always wins. Investors walk in with hope, but the system is designed so that Wall Street makes money whether you succeed or fail. And the worst part is, most investors never realize it. Brokers, analysts, and investment banks are not in the business of protecting your wealth. They are in the business of generating fees. Every time you buy or sell, someone on Wall Street earns a commission. That is why they encourage activity. They tell you about hot opportunities, breaking news, and urgent calls to action. The more you trade, the richer they become. Your losses are their profits. Analysts too often serve Wall Street, not investors. Their research reports are filled with optimistic language. Why? Because investment banks want corporate clients. If an analyst criticizes a company, that company might refuse to do business with the bank. So the reports lean positive, even when danger is near. Investors who trust these reports without question are walking blindfolded into traps. Then there are the financial media channels. They thrive on noise, not wisdom. Quiet patience does not sell advertisements. Excitement does. So they exaggerate news, promote fear or greed, and keep investors glued to the screen. The cycle of dopamine rush continues. You hear, "Buy this now," or "Sell before it is too late." And in that rush of emotion, you act without proper thinking. Mutual funds and large institutions add another layer of pressure. They measure success not in years, but in quarters. Their managers want to show activity because inactivity looks lazy. They want to show performance, even if it means taking risks. The client, in the end, pays the price. Wall Street has built an entire culture around the idea that complexity equals intelligence. Thick reports, technical charts, and confusing jargon give the illusion of expertise. But beneath the surface, the goal is simple. Keep money moving. Keep investors dependent. Keep them believing that Wall Street knows better. Seth Klarman warns us to see through this illusion. The truth is, no one cares about your money more than you do. If you give away your decisions to brokers or media, you are handing over your future to people whose interests are not aligned with yours. Independent thinking, patience, and discipline are the only shields against this system. But here is the irony. Even when investors realize that Wall Street works against them, they still fall into the trap of institutions. They give money to professional managers, hoping for better results. And yet, in this so-called performance race, it is often the client who ends up losing. That is the theme of our next chapter. Chapter 4. The Institutional Performance Derby. The client is the loser. Imagine a horse race. Every horse runs at full speed. Every jockey is desperate to win, and the crowd is screaming with excitement. Now imagine that instead of horses, the racers are large investment institutions, mutual funds, pension funds, hedge funds. They are running not for long-term wealth, but for short-term performance. This is the performance derby. And in this race, the horses may run, the jockeys may shine, but the one who often loses is the person who placed the bet, the client. Institutions manage money for millions of individuals. On paper, this looks safe. Professional managers, research teams, and powerful resources are supposed to protect investors from mistakes. But in reality, most institutions are trapped in a cycle of competition. They are judged not by how much wealth they create over decades, but by how they perform compared to rivals every quarter or every year. This creates a dangerous pressure. Managers fear falling behind because underperformance leads to losing clients. So they take risks they would never take with their own money. They buy stocks simply because everyone else is buying. They avoid unpopular opportunities, even if they are undervalued, because no manager wants to explain to clients why they hold something the market currently dislikes. The result is herd behavior. Institutions start to look alike. Their portfolios mirror each other. Their strategies overlap, and when the market crashes, all of them fall together. The client, who believed professional management meant safety, ends up suffering heavy losses. Another problem is the obsession with benchmarks. If the market index rises 20% and your fund rises 15%, you are told it is a failure, even if you made a solid gain. If the index falls 30% and your fund falls 25%, the manager calls it success, even though you lost money. For clients, this system makes little sense. They care about protecting and growing wealth, not about beating arbitrary numbers. Yet institutions continue to play the benchmark game because it protects them from criticism. Klarman calls this the tragedy of the performance derby. Institutions win by collecting fees year after year, regardless of results. Managers win by keeping their jobs and reputation safe, even when clients lose. The client, ironically, is the only true loser in this race. So what is the lesson? Investors cannot blindly trust institutions to act in their best interest. True protection comes only from a philosophy that values safety, discipline, and independence over competition. But history shows that institutions are not the only ones guilty of chasing illusions. Even individuals, hungry for higher returns, often get seduced by financial products that sound attractive but hide dangerous risks. Nowhere is this clearer than in the junk bond craze of the 1980s. Investors believed they had discovered value, but in reality, they were walking into a trap built on myths and misconceptions. That is the subject of our next chapter. Chapter 5. Delusions of Value. The myths and misconceptions of junk bonds in the 1980s. The 1980s were a time of glitter and speed in the financial world. Wall Street had found a new toy, and it was called the junk bond. These were bonds issued by companies with weak financial health, rated below investment grade. On the surface, they looked risky. But Wall Street painted a different picture. They called them high-yield bonds. The message was simple. Higher risk means higher return, and if you diversify enough, the risk disappears. Investors believed this story. Billions of dollars poured into junk bonds. Why did people fall for it? Because the promise was irresistible. Ordinary bonds from strong companies offered safe but small returns. Junk bonds dangled double-digit yields. Investors saw only the reward, not the danger. The dopamine rush of potential high income blinded them to the reality of collapse. The myth was that junk bonds represented hidden value. Wall Street analysts claimed these bonds were unfairly punished by rating agencies. They argued that many junk companies were actually strong, just misunderstood. But the truth was harsher. Many of these companies were drowning in debt, with no real capacity to pay it back. The risk was not misunderstood. It was real. Another misconception was that diversification would protect investors. If you owned hundreds of junk bonds, the theory said, a few defaults would not matter. But in reality, when economic conditions worsened, many junk bond issuers failed at the same time. Instead of balancing risk, diversification spread the poison across portfolios. The final myth was that the junk bond market was permanent. Investors assumed it was a new era in finance. But markets built on weak foundations do not last. By the end of the decade, many junk bonds collapsed, wiping out fortunes. Famous firms disappeared, and countless investors learned the hard way that chasing yield without safety is like building a house on sand. Seth Klarman points out that the junk bond craze was not just about financial products. It was about psychology. Greed made people ignore warning signs. Wall Street's marketing turned risky debt into a golden promise. Investors convinced themselves that risk was an illusion. This was not value investing. It was a dangerous fantasy. The lesson is clear. True value cannot be created by clever packaging or by renaming risk as opportunity. Value comes only from understanding what something is truly worth and buying it with a margin of safety. Anything else is speculation dressed in fine clothes. And this realization brings us to the heart of Klarman's message. If speculation, illusions, and institutional pressures all lead to loss, then what is the alternative? The answer is a disciplined philosophy that rejects noise, ignores illusions, and focuses only on real value. That philosophy is value investing. In the next chapter, we will explore what it means, why it works, and why it requires a margin of safety above all else. Chapter 6. A Value Investment Philosophy. Every great investor needs a guiding philosophy. Without it, you are like a ship sailing in the dark without a compass. Seth Klarman explains that value investing is not just a method of picking stocks. It is a mindset, a disciplined way of thinking about money, risk, and opportunity. While most investors chase trends or follow market noise, the value investor remains grounded in principles. The core belief is simple. Every security has an underlying value, and this value can be very different from its current market price. The job of the investor is to calculate that intrinsic value carefully, and then act only when the market offers a clear bargain. This is why value investing is often compared to buying a dollar for 50 cents. The gap between price and value is where opportunity lives. But this philosophy requires patience. In fact, patience is one of the hardest parts. The market can stay irrational for longer than most people can stay calm. Many investors lose confidence when a stock does not move for months or even years. A value investor, on the other hand, accepts that markets eventually recognize true value, but on their own schedule. Waiting becomes part of the strategy. Another pillar of the philosophy is skepticism. Klarman stresses that investors must question everything. Financial reports, Wall Street opinions, media headlines, all of them can be biased or misleading. To protect yourself, you must do your own analysis, dig deep, and never assume that the market knows better than you. This philosophy also emphasizes risk control. Value investors do not try to maximize returns in the short run. Instead, they focus on minimizing losses over the long run. Klarman reminds us that avoiding big mistakes is more powerful than hitting occasional home runs. Consistency, discipline, and safety matter more than excitement. And perhaps the most surprising lesson is this: value investing often feels uncomfortable. When a company is cheap, it usually means that others have abandoned it. News headlines may be negative. Analysts may be bearish. Your friends may laugh at you for buying what they see as a dying business. But this is where opportunity hides. The best bargains are found in places where others are unwilling to look. This chapter makes one thing clear: value investing is not for everyone. It demands patience, discipline, independence, and courage. But for those who adopt it, the rewards are not only financial, they also include peace of mind, because you know you are guided by logic, not by emotion. And now that we understand the foundation of this philosophy, Klarman takes us to the next crucial step. Before you can apply value investing in real life, you must define your own personal goals. Because without knowing what you are aiming for, even the best philosophy cannot guide you. Chapter 7. Defining your investment goals. Before you start investing, you must ask yourself a powerful question. What do I really want from my money? Seth Klarman explains that too many people enter the market without answering this. They jump in because they see others making profits. They buy stocks because the headlines are exciting. But without clear goals, they drift aimlessly, becoming victims of greed, fear, and randomness. Defining your investment goals gives you direction. For some, the goal might be long-term wealth creation. For others, it could be stability, security, or a steady income. And for a few, it might be about preserving capital at all costs. Each of these goals requires a different strategy. You cannot treat them the same. If you are saving for retirement 30 years away, you can afford patience. But if you are saving for your child's education in 5 years, your choices must be more conservative. Klarman emphasizes the importance of aligning risk tolerance with your goals. Many investors overestimate their ability to handle risk. They think they are brave until the market crashes and they panic sell at the worst time. True investing wisdom comes from being honest with yourself. How much volatility can you endure without losing sleep? How much money can you afford to lock away for years? These answers must guide your choices. Another part of defining goals is recognizing constraints. You may not have unlimited capital, time, or knowledge. That is fine. What matters is tailoring your investment plan to your reality. If you lack expertise in complex derivatives, do not chase them. If you cannot watch the market daily, avoid strategies that demand constant attention. Value investing itself is powerful because it allows for a patient, long-term approach that fits many ordinary investors. Klarman also warns against vague or emotional goals. Wanting to get rich quickly is not a goal. It is a fantasy. Real goals are measurable and practical. For example, I want to grow my capital by 5% annually while avoiding any risk of permanent loss. Such clarity prevents you from making impulsive moves that later turn into regrets. Defining goals also forces you to think about time horizons. Markets are volatile in the short term. Prices rise and fall daily with no clear pattern. But over long horizons, true value emerges. If your goals are short-term, the odds of failure increase. If your goals are long-term, patience becomes your strongest ally. At the end, Klarman makes a critical point. Once you define your investment goals, you must stick to them with discipline. The market will tempt you with shortcuts. Friends will brag about quick profits. News anchors will shout about trends. But if your goals are clear, you will not be swayed. You will remain grounded, calm, and focused. This chapter is like drawing a map before starting a journey. Without the map, you will get lost. With the map, every decision becomes easier. And once the goals are set, Klarman shows us the most powerful tool to protect them. It is the concept that gives the book its very name. Chapter 8. Value Investing. The Importance of a Margin of Safety. This chapter is the heart of Seth Klarman's philosophy. It is where the name of the book comes from. The margin of safety is the single most important principle of value investing. Without it, even the smartest analysis and the best intentions can collapse under market uncertainty. With it, investors protect themselves from mistakes, bad luck, and unpredictable changes. So what is the margin of safety? Imagine you are buying a house worth $100,000. After doing your research, you are convinced that this is its fair value. But instead of paying the full price, you wait for a deal. If you can buy it for $70,000, you now have a cushion. Even if the market falls or you miscalculated some costs, you are still protected. That cushion is your margin of safety. Applied to investing, this means buying securities at a significant discount to their intrinsic value. It is not about predicting the future perfectly. It is about allowing room for error. No matter how skilled you are, mistakes happen. Companies face surprises. Economies shift. Political events shake markets. A margin of safety ensures that you survive these shocks without losing your capital. Klarman explains why this principle is so critical. Most investors chase growth, momentum, or exciting stories. They buy stocks priced for perfection. But if perfection does not happen, losses are severe. Value investors, in contrast, focus on minimizing risk. They know that protecting capital is more important than chasing maximum returns. In the long run, survival is the real secret to success. The margin of safety also frees investors from constant worry. If you buy with a wide discount, you can be patient. You do not need the market to agree with you tomorrow. You can wait months or years until prices reflect true value. This patience is what separates value investors from speculators. Another lesson in this chapter is humility. The margin of safety acknowledges that humans are imperfect. Analysts can misjudge earnings. Managers can fail. Unexpected disasters can strike. By demanding a discount before investing, you admit your limitations and protect yourself from arrogance. But Klarman warns that the margin of safety is not a magic shield. It cannot protect you if your analysis is wrong from the start. If you miscalculate intrinsic value, buying cheap may still lead to losses. That is why careful research and discipline must come before applying this principle. The power of this idea is that it works across all kinds of markets. Whether in booming times or in recessions, the concept remains valid. Buy below value. Give yourself room for error. Protect your capital. That is the timeless truth of value investing. By the end of this chapter, the philosophy of value investing is fully armed. We now know why patience, discipline, and skepticism matter, and we understand how to safeguard ourselves with the margin of safety. But Klarman is not done yet. To truly apply this principle, we must look deeper at the foundation beneath it. What lies at the very root of this philosophy? Chapter 9. At the root of a value investment philosophy. Every philosophy stands on a foundation. For value investing, Seth Klarman explains that the root is not a complicated formula or a secret insider trick. It is common sense combined with discipline. The philosophy is built on a few timeless truths about markets, human behavior, and risk. Understanding these roots makes the rest of the process much stronger. The first root is recognizing that markets are inefficient. Prices do not always reflect true value. This is because markets are driven by human beings, and humans are emotional. Greed pushes prices too high. Fear pushes them too low. Headlines, rumors, and hype create waves of irrational behavior. A value investor sees these inefficiencies not as problems, but as opportunities. When others panic, you can buy cheap. When others are euphoric, you can stay away. The second root is risk awareness. Most investors think only about potential returns. They ask, how much can I make? Klarman teaches us to ask a better question. How much can I lose? Value investing begins with the protection of capital. This defensive mindset keeps you alive in storms. It may not sound glamorous, but in the long game of investing, survival is victory. Another route is independence of thought. The crowd is often wrong. If you follow Wall Street trends or media excitement, you will likely pay too much and sell too soon. Value investors learn to think differently, even if it feels lonely. You must be willing to stand apart, to buy when others sell, and to hold when others mock you for being too cautious. This independence is not arrogance, it is clarity. The philosophy also rests on humility. Nobody can predict the future with certainty. Economic cycles, political changes, global crises, these can turn forecasts upside down overnight. By admitting this uncertainty, value investors demand a margin of safety. They leave room for error because they know perfection is impossible. Finally, the root of value investing is patience. Markets do not reward you instantly. Sometimes the value of a company is obvious, but the price remains low for months or years. Many investors give up, moving to the next shiny trend. Value investors wait calmly, trusting that eventually the market will recognize reality. Patience turns time into an ally, rather than an enemy. When all these routes come together, recognizing inefficiency, focusing on risk, thinking independently, acting with humility, and practicing patience, you have the true spirit of value investing. It is not about chasing profits. It is about building wealth steadily, carefully, and safely. This chapter reminds us that philosophy is not just theory. It is a mindset you carry into every decision. Once these roots are strong, the tree of value investing can grow. And to make that tree stronger, Klarman now introduces a crucial skill. If you want to buy with a margin of safety, you must know how to judge what a business is truly worth. Chapter 10. The Art of Business Valuation. Understanding the true value of a business is the skill that separates successful value investors from everyone else. Seth Klarman emphasizes that investing is not about following trends or listening to hot tips. It is about estimating the intrinsic worth of a company and then comparing it to the price the market is asking. This is the art of business valuation. Valuation begins with numbers. Investors look at earnings, cash flows, assets, and liabilities. But it is not just about reading reports. The key is interpretation. How reliable are these numbers? Are profits sustainable or temporary? Are assets overvalued on paper, but useless in reality? Klarman warns that blindly trusting financial statements can be dangerous. You must dig deeper, understand the story behind the numbers, and adjust for uncertainties. Another important concept is the difference between price and value. The market often prices a stock based on emotion rather than fundamentals. A popular company may trade at a sky-high price, while a solid undervalued company may be ignored. A skilled value investor buys the overlooked, the out of favor, and the misunderstood. This is where opportunity lives. Klarman also stresses the importance of conservatism. Do not assume perfection. Businesses face competition, technological change, and management errors. By applying cautious assumptions when calculating value, you build a margin of safety. Overly optimistic forecasts are a recipe for disappointment. Valuation is both an art and a science. Numbers matter, but so do qualitative factors. Management quality, industry trends, brand strength, and regulatory risks all influence intrinsic value. The best investors combine rigorous analysis with judgment honed by experience. Importantly, valuation is dynamic. A business may improve, decline, or face unexpected challenges. Regularly revisiting your assessments ensures that your decisions remain sound. This is not a one-time calculation. It is an ongoing process. Mastering valuation allows you to act with confidence. When a stock trades well below your estimate of intrinsic value, you know you are getting a bargain. When it exceeds your calculations, you know to wait or sell. Without this clarity, investing becomes guesswork, driven by emotion and luck rather than skill. Once you understand valuation, the next step is to put it into action. Numbers alone do not create wealth. You need a structured process to identify, analyze, and buy investments that meet your criteria. This leads us to the next chapter. Chapter 11. The Value Investment Process. Knowing a business's value is one thing. Turning that knowledge into successful investments is another. Seth Klarman explains that a disciplined process is what separates consistent investors from those who succeed by luck. The value investment process is a systematic approach that guides decisions, reduces errors, and helps maintain a margin of safety. The first step in the process is identifying opportunities. Not every undervalued stock is worth buying. You need to filter for businesses with solid fundamentals, clear financial records, and a potential for price to eventually reflect intrinsic value. Screening helps narrow the field, but judgment is essential to avoid overlooking hidden risks or misjudging potential. Next comes thorough research. This is where the investor becomes a detective. Study financial statements, market trends, industry competition, and management quality. Understand both the numbers and the story behind them. Klarman warns against relying on others' opinions or superficial analysis. Deep research reveals risks and opportunities that are invisible to casual observers. Once research is complete, the next step is valuation. Estimate the intrinsic value conservatively, considering both potential upside and downside. Always incorporate a margin of safety. Overestimating value or ignoring risk is a common mistake that turns promising investments into losses. Decision-making follows. This is where discipline matters most. Even when a security seems cheap, you must wait for the right price. Patience is a critical element of the process. Emotional impulses or fear of missing out can push you to buy too early or sell too late. A disciplined investor follows rules, not emotions. After investment, monitoring is essential. The value investment process does not end with purchase. Markets evolve, businesses change, and new information emerges. Continuously reassess the situation to ensure that the investment still meets your criteria. If it does not, take action. This proactive approach protects capital and allows for better opportunities elsewhere. Klarman also emphasizes portfolio construction. Diversification is necessary to manage risk, but over-diversification dilutes returns. Each position should be meaningful, with clear reasons for inclusion. The process ensures that your portfolio is a carefully curated collection of high-conviction investments, rather than a random assortment of trends. Finally, the value investment process integrates discipline, patience, and risk control. It creates a structured framework that allows investors to act logically, even when markets are irrational. By following this process, you avoid common mistakes, capture opportunities others miss, and steadily build wealth over time. Understanding the process brings us to the next challenge: finding investments that are genuinely attractive in a noisy and inefficient market. Klarman addresses this in the next chapter. Chapter 12. Investment Research. The challenge of finding attractive investments. Finding truly attractive investments is far harder than it seems. Seth Klarman explains that the market is full of noise, hype, and misleading signals. Investors who rely on headlines, popular trends, or conventional wisdom often fail. The challenge lies in separating real opportunities from illusions. The first hurdle is information overload. Every day, thousands of news articles, analyst reports, and financial updates flood the market. Most of it is irrelevant or biased. A value investor must filter carefully, focusing only on what affects intrinsic value. Understanding what matters and ignoring the rest is a skill that separates disciplined investors from reactive speculators. The second challenge is mispricing. While the market is generally efficient over the long term, short-term mispricings occur frequently. Fear, greed, and emotion drive prices above or below true value. Klarman emphasizes that these inefficiencies are where opportunities lie. The key is patience. You cannot force a mispricing. You wait for the market to reveal undervalued or overlooked securities. Third, there is the difficulty of assessing risk. Many investments appear cheap, but the hidden dangers may outweigh potential returns. A company may have unstable earnings, weak management, or high debt. A rigorous investor evaluates all risks carefully, always prioritizing the avoidance of permanent loss over chasing profits. Research also involves thinking independently. Analysts, brokers, and media can create consensus opinions, but following the crowd rarely works. True value investors question assumptions, challenge conventional wisdom, and seek information others ignore. This often requires going beyond numbers to understand the qualitative factors, the company's culture, industry trends, and competitive advantages. Another aspect is timing. Attractive investments do not stay undervalued forever. Once the market recognizes the opportunity, prices rise. The investor must be ready to act decisively while maintaining discipline. Acting too early or too late can reduce returns or increase risk. Finally, Klarman reminds us that research is ongoing. The market evolves, and so must your understanding. Continuous learning and reassessment are critical. A security that once seemed unattractive may become a prime candidate later, and vice versa. Mastering research allows investors to identify rare bargains in a chaotic market. It is the bridge between understanding value and executing the investment process. But even with research skills, opportunities must be recognized in specific contexts where inefficiencies, catalysts, and constraints exist. These nuances are the focus of the next chapter. Chapter 13. Areas of Opportunity for Value. Investors, catalysts, market inefficiencies, and institutional constraints. Even the best research is useless without the right opportunities. Seth Klarman explains that value investors must learn to spot situations where the market's mispricing creates a chance to buy below intrinsic value. Not all undervalued securities are obvious. Some require understanding catalysts, inefficiencies, and constraints that influence market behavior. A catalyst is an event that can unlock value. It might be a merger, regulatory approval, restructuring, or management change. Without a catalyst, undervaluation can persist for years. Patience is required, but a well-timed catalyst can accelerate the recognition of true value, turning patience into profit. Investors who identify catalysts in advance gain a critical advantage. Market inefficiencies are another area of opportunity. While markets are often rational over the long term, short-term distortions abound. Fear, panic, overreaction, and misunderstanding can push prices far below or above intrinsic value. These inefficiencies create bargains for disciplined investors willing to go against the crowd. The key is careful analysis, not speculation. Institutional constraints also create opportunities. Large funds often face rules, regulations, or client pressures that prevent them from buying certain undervalued securities. Mutual funds, pension funds, and other institutional investors may avoid small-cap stocks, illiquid bonds, or distressed assets, not because they are bad, but because these investments do not fit their mandates. This leaves gaps in the market for individual investors to exploit. Klarman emphasizes that spotting opportunities requires creativity, research, and courage. Investors must be willing to explore neglected areas, challenge conventional thinking, and act decisively when others hesitate. Many of the best returns come from situations that appear uninteresting or too complex for the average investor. Value investing is not about following trends or mimicking the market. It is about understanding where the market's imperfections create advantage. By combining research, valuation, and awareness of catalysts and constraints, investors can systematically find undervalued opportunities. The chapter concludes with a reminder. Opportunity is everywhere, but patience, discipline, and judgment are required to recognize it. Once identified, these opportunities may include specialized areas like thrift conversions or distressed securities. These topics are explored next in the following chapters. Chapter 14. Investing in Thrift Conversions. Thrift conversions are one of those unique opportunities that most investors overlook. Seth Klarman explains that in certain situations, savings and loan institutions, also known as thrifts, convert from one type of charter to another. This process can create temporary mispricing in their stocks or assets, which value investors can exploit. The key is understanding the regulatory and structural changes involved. When a thrift converts, it often changes its operations, capital requirements, or ownership structure. These shifts can confuse the market. Investors unfamiliar with the details may undervalue the company, creating a rare opportunity to buy below intrinsic value. Klarman emphasizes that these opportunities require careful analysis. Not every thrift conversion is profitable. Some institutions may have weak management, poor asset quality, or hidden liabilities. A disciplined value investor evaluates both the potential upside and the risks, ensuring that a margin of safety exists. Timing is also crucial. Mispricing during a conversion may last only a short period before the market adjusts. Acting too slowly can mean missing the opportunity. Conversely, acting too hastily without full research can lead to losses. Patience combined with preparation is essential. Thrift conversions also illustrate a larger principle. Markets are not perfectly efficient. Structural changes, regulations, and technical events can create pockets of opportunity where prices temporarily diverge from true value. Investors who understand these nuances can exploit them systematically. Klarman notes that while these opportunities are specialized, the principles apply broadly. Always seek mispricing. Assess risk. Look for catalysts. Maintain discipline. And always protect your capital with a margin of safety. This chapter sets the stage for even more complex situations, investing in financially distressed or bankrupt securities. These opportunities can be riskier, but also potentially more rewarding, provided you apply the same rigorous approach. Chapter 15. Investing in financially distressed and bankrupt securities. Some of the greatest opportunities in investing lie where others fear to tread. Seth Klarman explains that financially distressed and bankrupt companies are often ignored or avoided by mainstream investors. Yet, these situations can offer extraordinary returns if approached carefully and with discipline. Distressed securities are those of companies facing serious financial trouble. Their stock prices or bonds may trade far below what the underlying assets or future potential suggest. To the uninformed, this appears too risky. To the value investor, it may represent a bargain if the risks are understood and mitigated. Klarman emphasizes research as the foundation of this strategy. You must analyze the company's balance sheet, cash flow, and legal standing. Understanding the bankruptcy process or restructuring plan is essential. Not every distressed company will recover, and many investors lose money by jumping in blindly. Knowledge is your edge. Another critical factor is the margin of safety. In distressed investing, the margin is often found in the underlying assets, not the market price. A company may have valuable real estate, patents, or inventory that exceeds its debt obligations. If purchased at the right price, these assets can protect investors even if the business struggles or management fails. Catalysts are also important. Bankruptcy reorganizations, asset sales, or management changes can unlock value. Timing your investment around these events can significantly improve returns. Patience is key. Distressed situations often take months or years to resolve. Klarman warns that this type of investing is not for everyone. It can be volatile and psychologically challenging. Many investors panic during crises, selling at the worst possible time. A disciplined value investor, however, sees opportunity where others see fear. By maintaining objectivity and following a rigorous process, one can capitalize on situations others avoid. The lessons of distressed investing reinforce the broader principles of value investing. Research thoroughly, protect your capital, remain patient, and seek situations where the market underestimates value. Mastering this approach prepares you for handling complex securities and portfolio management challenges, which are discussed next. Chapter 16. Portfolio Management and Trading. Investing is not just about picking the right securities. Seth Klarman emphasizes that managing your portfolio is equally important. A well-constructed portfolio balances risk and reward, aligns with your goals, and allows you to act decisively when opportunities arise. The first principle of portfolio management is diversification. Spreading investments across different sectors, industries, and types of securities reduces the risk of a single loss wiping out your capital. However, Klarman warns against over-diversification. Owning too many positions dilutes returns and makes it difficult to focus on the best opportunities. A portfolio should be concentrated enough to benefit from your highest conviction ideas, yet diversified enough to protect against unexpected events. Position sizing is crucial. How much you allocate to each investment must reflect both the potential upside and the risk involved. Higher risk positions should occupy a smaller portion of your portfolio, while lower risk, high conviction investments can take up more space. This disciplined approach prevents catastrophic losses. Trading discipline is another cornerstone. Many investors act impulsively, chasing short-term gains or reacting to market noise. Klarman stresses that trades should be driven by analysis, valuation, and opportunity, not emotion. Waiting for the right price and acting decisively when it appears is far more effective than constant buying and selling. Liquidity and flexibility also matter. A good portfolio allows you to seize new opportunities without being forced to sell at a loss. Maintaining some cash or liquid assets provides optionality. This is where value investors gain an advantage over those fully invested or locked into rigid strategies. Klarman highlights the importance of reviewing your portfolio regularly. Market conditions change, businesses evolve, and new information emerges. Reassessing positions ensures they still meet your criteria for value and margin of safety. Selling is as important as buying. Exiting an investment that no longer offers protection or upside is key to long-term success. Ultimately, portfolio management and trading are about discipline, risk control, and alignment with your investment philosophy. By constructing a thoughtful, flexible, and risk-aware portfolio, you create the foundation for compounding wealth over time while minimizing the chances of permanent loss. With a well-managed portfolio, investors can explore specialized opportunities and alternatives, which is the focus of the next chapter. Chapter 17. Investment Alternatives for the Individual Investor. Not all investors have access to institutional tools, research teams, or large capital. Seth Klarman explains that individual investors must understand the alternatives available to them and choose wisely. The key is to focus on strategies that align with personal goals, risk tolerance, and resources. One alternative is direct stock investing. Buying shares of individual companies allows for high conviction positions, but it requires careful research, patience, and discipline. Investors must evaluate businesses thoroughly, estimate intrinsic value, and maintain a margin of safety to protect against mistakes or market volatility. Another option is bonds and fixed income securities. While traditionally less risky than stocks, they still carry credit and interest rate risks. Value investors look for opportunities where bonds are undervalued relative to their risk, providing steady income while preserving capital. Mutual funds and exchange-traded funds, ETFs, are convenient for diversification. But Klarman cautions that fees and management constraints can reduce long-term returns. Many funds chase benchmarks rather than value, which can hurt individual investors seeking real bargains. Understanding fund strategy and cost structure is essential before investing. Specialized alternatives include real estate, convertible securities, closed-end funds, and even distressed or small-cap investments. These areas often carry higher risk, but can offer opportunities that are less accessible to institutional investors. Discipline and research remain critical to avoid overpaying or underestimating risk. Klarman emphasizes the principle of simplicity. Individual investors should focus on areas they understand deeply. Chasing exotic products or complex derivatives may seem attractive, but lack of understanding increases the chance of loss. True value investing is about leveraging knowledge, patience, and caution. Cash is also an important alternative. While holding cash may feel unproductive, it provides flexibility to act when true bargains appear. Patience and optionality are often more valuable than constant market activity. The chapter reminds individual investors that opportunities exist in many forms, but the common thread is careful analysis, margin of safety, and disciplined execution. By choosing alternatives wisely, individuals can achieve results comparable to institutional investors while avoiding unnecessary risks. The final section of the book provides a glossary of key terms, reinforcing the concepts, language, and principles introduced throughout the chapters. Chapter 18. Glossary. Seth Klarman concludes margin of safety with a glossary, which may seem simple but is crucial for understanding value investing. The glossary defines key terms, concepts, and financial jargon used throughout the book, ensuring that investors can navigate the market with confidence. Terms like intrinsic value, margin of safety, risk, and diversification are explained clearly. Understanding these is more than academic. It directly affects how you make decisions, assess opportunities, and protect your capital. Klarman emphasizes that mastering the language of investing builds mental clarity, helping you separate speculation from real value. The glossary also reinforces concepts that recur across chapters. For example, catalysts, distressed securities, thrift conversions, and market inefficiencies are all defined to highlight how they create opportunities. By revisiting these terms, readers solidify their understanding and can apply the principles consistently. Importantly, the glossary reminds investors that value investing is a structured approach. It is not guessing or following trends. Each term is tied to practical action, analyzing businesses, calculating intrinsic value, identifying mispriced assets, and maintaining a margin of safety. The language becomes a toolkit for disciplined investing. In essence, the glossary is a reference, a learning guide, and a reinforcement of the philosophy. It ensures that no matter your prior knowledge, you can understand the principles and apply them effectively. By mastering these definitions, investors gain both the confidence and clarity needed to navigate markets intelligently. With this, Klarman completes his guide to value investing. From understanding where most investors stumble, to avoiding myths, defining goals, valuing businesses, finding opportunities, and managing portfolios, the book provides a complete framework. Every chapter reinforces the same timeless lesson. Protect your capital, act with discipline, think independently, and invest with a margin of safety. Margin of safety is more than a manual. It is a philosophy. Applying its principles consistently can transform how investors approach markets, turning uncertainty into opportunity and speculation into informed decision-making. Remember, investing is a journey, and knowledge is your greatest advantage. Hit the subscribe button now and join a community of learners who are turning insight into action.